I need to just do this reading for our friends in compliance and we'll move on from that. So securities offered through LPL Financial, member FINRA SIPC. The opinions voiced are the general information only and are not intended to provide specific advice or recommendations for any individual. This information is not intended to be a substitute for specific individualized tax or legal advice. We suggest you discuss your specific situation with a qualified tax or legal advisor. Ed Slott is not affiliated with LPL Financial or Storen Financial. I'm Greg Storen, and I'm excited to be here today. This is a big deal for me. Our man Ed Slott, America's IRA expert, is going to be presenting for us today. In my opinion, the man's an all-star. I love the man. And I want to first talk about Storen Financial Group. We started Storen Financial Group in 1999. My wife, Kim Storen, and myself started with 125 clients in 1999. Today, we have over 5,000 tax clients, and we manage over $200 million of assets for our investment clients. We are fiduciary advisors, and I bring that up because that's incredibly important in today's world. When you're looking for an advisor, you want a fiduciary advisor, an advisor that is tasked with doing what is in the client's best interest. So being a fiduciary advisor is very important. At Storen, we are all about education, and we could not accomplish what we do for our clients if we didn't have the 25 all-star amazing employees that we have. We have 25 great people that support us. They support our clients every day, and they make this all happen. At Storen, we're about education, and that's where Ed comes in. I've always been about education. I've been about trying to better myself, better my staff, and better our clients. I was able to meet with Ed 17 years ago in his 2-day course that enabled me to become what today is a master elite advisor. Ed's vision has been to educate advisors to go back and educate their staff and their clients. At Storen, we've been able to do that. And our goal by educating our clients and our staff is to avoid very costly mistakes. Clients' biggest assets besides their home is typically their IRA, their 401k, or their 403b. We oftentimes find ourselves assisting new clients with putting out fires, putting out problems that other tax advisors, other investment advisors have created through lack of knowledge or lack of due diligence or lack of homework. We don't want to be on the wrong side of the desk and be the advisors or tax advisors to create those problems. That's why we educate, we learn, and we never stop. And that's why I hang out with guys like Ed Slott that can teach me and help me understand what I need to know in this world of just ongoing regulatory change. And if our clients understand their investment plans, their tax plans, and they're educated, then they'll make solid, proactive decisions which help them become successful in their financial world. And we can control that. We can't control markets, but we can control what happens to their plans from a regulatory perspective. And we can help them manage how much tax they pay based on managing the buckets that they choose to put their dollars into. And I think that's just as important, if not more important, than deciding what investment strategies they choose. So education is just key for us, and we never stop learning. And Ed has been such an enormous part of that for me. I'm one of 400 advisors that belong to the Ed Slott Elite, Master Elite, and Elite group. And it's just one of the best things that I've ever done in my life. We have a great time when we all get together and hook up with Ed and his technical advisors and study cases, study regulations, study changing laws. We meet four days a year. And then when we're not meeting, Ed's producing a monthly newsletter. Ed's providing emails with updates. For example, we got an email today. The Secure Act is coming out with what Ed refers to as Son of Secure. There's going to be changes potentially to the Secure Act. We're already talking about it. It's not even a law yet, but we're already talking about it because we want to be ready to respond and make changes when that law comes out. With that said, enough about Storen Financial Group, and I wanted to introduce my good friend Ed Slott, who I really value and appreciate, and I want to say thank you to. Ed has, as I said, is such a knowledgeable individual in IRAs and retirement planning. Ed's written a dozen books on the subject. Ed has raised millions of dollars for public television. Ed is sought after by all sources of media, such as the Wall Street Journal, Fox Television, CNBC, USA Today. Anybody that has questions reaches out to Ed for his knowledge. And he's an awesome dude. So with enough said, I'm going to introduce and turn it over to Ed Slott. And Ed, if you want to come on and get the show started.
Yeah, wow, what a
appreciate
wind up there, boy. Uh, all right, I appreciate it. And what I'm going to do now, Greg, and while you're with me, yes, it is a critical item to have an educated advisor, more so than ever before. So I'm proud to be here with you after training with us for well over 15 years. That's a commitment. So right now I'm going to bring you to my program here. So you should see that on the screen. You see that, Greg?
Yes, sir.
And like they say in the Indy 500, they're off to the races. Let's go. So here we go. This is called the New Retirement Savings Time Bomb, based on my new book that just came out this year. So you might say, Ed, was there an old retirement savings time bomb? Yes, and now it's worse. There are new and even more severe threats to your retirement savings. And of course, I'm talking about the tax, that ticking tax time bomb. Say that 3 times fast. But I'm here to show you how to disarm that ticking tax time bomb and make the tax law work for you rather than against you with a 5-step plan. So I'm going to take you through the book so you'll know all the secrets, and I'm going to give you the secret to the book too. So let's dig in. But before we do, I know Greg talked a little about his membership in the Master Elite IRA Advisor Group, but what does that mean? This is a group of advisors like Greg that have made a commitment, and in some cases like Greg was really there from almost the beginning when I started this, like he said, 15, 17 years ago. I lost count already. Imagine that kind of commitment to taking advanced ongoing education to help you and to help himself, and basically to help him do a better job for you. So he has us. One of the benefits of being a member of this group, as he said, we're constantly in the loop with him. He talked about what I call Son of Secure. Actually, some people are calling it Secure 2.0, but he's always up to date on whatever is going on. He stays in shape, so to speak. He's always, keeping up to date on all this stuff. But in addition, he has me and my team of IRA experts, the best in the country, in my opinion, whenever he has a question. And that's a good back office. So he attends webinars, seminars, everything. And he's one of the top advisors in our membership group. He's been there just about the longest. So that's some commitment to education. That's good for you to know. I saw this piece in the New York Times today. Not a great piece. It was talking about the airline pilots. I don't know if you could see this. Well, let me show you this. You see that headline? That's in today's New York Times. I don't know if you could see it, but what it says is preparing to fly again is not like riding a bike. What's happened with these pilots, I don't want to scare you, but the article scared me. A lot of them during the pandemic were laid off, and they've been out of practice. So the article starts out, some of them are missing runways, flying at the wrong altitude, they're messing up their equipment, they're out of practice. Well, I saw this and I said, well, I'm glad you have nothing to do with this, but I'm glad you have an advisor available to you that is in practice, that has never been out of practice for almost 20 years. And that's what Greg has done with his membership in this educational group. I'm a CPA, just so you know. I don't sell any investment, stocks, bonds, funds, insurance, annuities, none of that. I'll probably tell you about that later. Anyway, we're an education company. We educate consumers like we're doing now, and financial advisors that want to make a commitment to education, as Greg has done right here. So let's dig in. What would you say is the most impactful but worst selling book of the last 100 years. For more than 100 years, this book has had more impact on every one of our lives than any other. Yet, no one will ever read it. Except for me, maybe. There's a hint to what it is. No one will check it out of the library, buy it on Amazon, and absolutely no one will make a Netflix series out of it. That I can assure you. What book is it? It's the U.S. tax code. It permeates our life. Think about it. From the time you get your first job, remember when your kids came home with their first job? Remember that? And they looked at their W-2 and say, "Who is this guy FICA, and why is he taking my money?" And then there's withholding tax, and then maybe they buy a house and they have real estate taxes, they sell investment, capital gains taxes, and it never ends. Even after you're dead, they have an estate tax. So taxes are a big deal, but even more so when it comes to your retirement savings, your IRA, your 401k. Most people know why it's important to save for retirement and how to do it. But what good is saving if you're going to turn chunks of that money over to Uncle Sam? Because what we have in these tax deferred accounts is a building, growing, looming, unpaid tax debt. That's what I call the ticking tax time bomb. And it depends how you own your retirement savings. And that's what we'll talk about right now. There's a big difference between tax deferred, which is what most people have, and tax free. That huge difference comes down to one little 3-letter word: yet. Tax deferred means you won't pay taxes on that money yet, but you will at some future higher rate probably, and on a higher balance at the worst possible time in retirement when you need the money the most. As opposed to tax free, which means you'll never pay taxes on that money. So that's my first rule for today. I love tax free. Tax free, who could argue with that, is always better. Remember that. Tax free is always better. You keep 100% of your money. So this is that looming uncertainty I'm talking about. How bad could that retirement savings time bomb be? Well, that's why I said, what good? It doesn't matter about your investments. Of course, that matters, but it doesn't matter how much you make. When it comes to taxes, it's how much you keep after your taxes, which is why we're doing this program, which is why Greg studies this so much, to help you keep more of your hard-earned money. That's the focus of our program and everything I do for consumers and for training advisors, helping people keep more of their hard-earned saving, to have more, keep more, and make it last. So how bad could future taxes get? Well, there's one way to figure that out. Look to history. So look what I've given you, the full history of the top federal tax rates from the time we began taxes with the 16th Amendment in 1913. But take a look at this. You see, I highlighted the years 1946 through 1964. These are the years people like me, and probably many of you, the baby boomers, were born. Take a look at the top federal tax rates. For each of those years, 1946 through 1964, the top federal tax rate exceeded, get this, 90%, except for the last year, 1964, when the Beatles came to America, and everybody was so happy that they lowered the top federal rate all the way down to only 77%. Mark Twain had a saying, history doesn't repeat itself, but it rhymes. Or you know the other saying, those who don't learn from history are bound to repeat it. I look at the debts and the deficits of our country and what's being proposed now. I believe tax rates are going to go through the roof. So now is the time to act. And I'm going to give you the secret right now to keeping more of your hard-earned money. And this is in the book. This is the whole theme. And Greg is well trained in this. The whole point is to keep more of your money. And you know how some books, they tell you the secret at the end, or they make you figure it out? I'm giving you that secret right now. How can you lower or eliminate future taxes? The secret? Pay taxes now. What? What kind of secret is that? That means I have to lay out more money now. The foundational principle of all good tax planning is this: always pay taxes at the lowest rates, which may be right now. You see this? Right now, we're in the lowest rates you may ever see in your lifetime. That is the time to strike. Always pay taxes at the lowest rates. And you do that by moving your money from accounts that are forever tax deferred, to never tax free. I want you to get your plan, not the government plan. You know, when I say that, people say, Ed, what's the government plan? Oh, that's easy. Doing absolutely nothing and letting it happen to you. Doing nothing, watch your IRA or 401k grow and grow and grow, not only to realize when you get the money out, you're going to have to share chunks, a lot of that money, with Uncle Sam. You shouldn't be sharing that money with Uncle Sam. And I don't know if you know this, he's not even your real uncle, okay? No need to share all of that money with Uncle Sam. So why don't more people do it? Because the secret: pay taxes up front, get rid of the problems. Kind of like paying off a mortgage up front. The minute you do that, all your money grows 100% for you. So most people don't get this. They're too short-sighted. They focus on, well, if I have to pay taxes now, I'm out money now. No, you get something for your money. You get tax freedom. You free up your retirement savings, like owning your own home free and clear. You want to own your own retirement account free and clear, because once you move from forever tax to never tax, guess what happens? All the gains grow for you 100%. You never have to share that for the rest of your life. So most people miss out because they don't know the secret. They just focus on what does it cost now, rather than the big benefit you get later, having more money, more of it tax-free, and more of it available to you without any of these problems. Probably the best way to describe the taxes is like a stock. You want to buy low and sell high. And probably the best one who ever described it is the old comedian Henny Youngman. He didn't realize how smart he was. And I love this saying. He said, I'm putting all my money in taxes, the only thing sure to go up. He was right. He was right about that. So now that we know the problem, we have this big, growing, compounding, unpaid debt in our retirement account, whether it's your 401k or your IRA or your 403b. Every day that goes by that you do nothing, you're on the government plan, and you're building a debt that has to be repaid at the worst possible time. In retirement, when the paychecks have stopped, when you're the most vulnerable, when you'll need every dime. Imagine waking up in retirement and thinking you have all this money, only to find out maybe tax rates are up to 50%. So what are we going to do about it? Well, there's my 5-step plan to disarm that ticking tax time bomb. And there are the 5 steps, and keep the secret in mind. The first one is timing. Timing is everything, especially when it comes to taxes, but in life. Doing the right things at the right time, investing in, Dogecoin at the right time. Don't do that. It's all about timing. Too late for that, all that nonsense. Or meeting the right person at the right time. You know, I am not a cook by any means, but I am an eater. I'll bet you are too. Look, we have that in common. We both eat. But I am an eater, and I know timing matters. The timing will make the difference whether that meal that's cooked is gourmet or garbage. Now, if it's garbage, you can always make an omelet. You can't mess that up. Even if you mess up the omelet, you can order out. That's why they have Uber Eats. So you always get a second chance. Not so when it comes to taxes on your retirement savings, on your IRA, on your 401k. You know why? I always say your retirement account's like an eggshell. You break it, it's over. You get one chance to get this right. So you have to know what to do. Now, unfortunately, the tax rules in this area, this is why Greg studies this so much, are not only complex, but rigid and unforgiving. You don't get a lot of second chances. So you have to have an advisor that's well trained in this. And that's what Greg is committed to with membership in our Master Elite IRA Advisor Group. So there's 3 stages in taking money out. The timing, early, sweet spot, and RMDs, required minimum distributions. Let's dispense with early. That's taking money out of your retirement account before age 59 and a half. I don't think anybody should be doing that unless you desperately need the money, because if you take it out early, number one, you may have a 10% penalty, and number two, if you're going to raid your own retirement savings, what are you going to have to do? What are you going to have available in retirement? But then we get to this sweet spot, my favorite spot, ages 59 and a half to 72. I'll bet that's a lot of you. Why? Well, before 59 and a half, I told you you had the 10% penalty. But at age 72, you go on the government plan. You're forced to start taking money down as required minimum distributions, even if you don't want to. Now, it doesn't mean you can't do any planning after 72. You're just constrained by those required distributions. But in between, that's why I call this the sweet spot, there are no tax rules to worry about, no distribution penalties, and no RMDs. So this is where you want to do all your planning, and it always comes down to this. The more you plan, the more you keep, but you need to work with an advisor that's well trained. Most are not. This is why I'm so proud to do this program for Greg with his tremendous commitment. Like I said, almost 20 years, and he never stops. He's always on. He was on a program with us a couple of weeks ago. So there is the timing. Then once we hit age 72, well, congratulations, that's when you're forced to take money out at 72. There are some exceptions, but if you miss an RMD, a required minimum distribution, woo, a 50%, I call it punishment tax. You don't want that happening, so you don't want to miss RMDs. Just a note on this, they're back. They were waived last year because of the COVID, but they're back this year, so don't miss those. That's step one, the timing. Step two, I call Secure Act. I named it after, I call Secure It, the step, but I named it after what Congress called the Secure Act. After studying tax law for over 40 years, there's been many changes, but there's one thing that's always been a constant. Whenever Congress names a tax law, you can almost always bet that whatever they name it, it does the exact opposite. The Secure Act. When I saw that name, the Secure Act, I'm thinking, hold on to your wallet. And sure enough, they took away some of the biggest benefits in the tax code for your beneficiaries for wealth transfer and estate planning, getting IRAs over to your children and grandchildren. Congress felt the law was too rich. They felt IRAs and retirement accounts should be for retirement, not to pass on to loved ones. So they eliminated something we called the stretch IRA, the ability where children and grandkids could have gone out for 50, 60, 70 years. That's a long time. Well, they got rid of that and replaced it with a 10-year rule. So you may have to look at your plan to see if it will still hold up. Remember, this is in effect now. The Secure Act has been in effect since 2020. Some people forgot about it because we had the COVID pandemic, we had the CARES Act, and it overshadowed this. But this is going to be here for a long, long time. So most people don't get the stretch IRA anymore, except for spouses. A surviving spouse, you're fine, and certain people called eligible designated beneficiaries. I didn't make up that term. Congress made that up. So a spouse is exempt. So you need to update your plans. Now here's the problem. Many people, I've been hearing because of the pandemic, have run to their estate planning attorneys, been updating their plans, and they think they have a plan. They have a new will and trust. So then they tell me, well, I've already updated. I went to the attorney, got a new will, got a new trust, whatever. And I usually ask the couple, let's say a married couple, I said, how do you own your property? And most of them will say, well, we have a joint bank, brokerage, investment account, a joint home, life insurance, pensions, IRAs, real estate. So I always ask, you got to, and they always say, oh, I got a perfect will. I said, you got a perfect will? Yeah, where'd you get it? I don't know where they get these things, but probably at an attorney. You can get them at Bed Bath & Beyond, apparently. They have everything. Yeah, and everything's 20% off. Where would you get a will at Bed Bath & Beyond? Well, obviously, in the Beyond section. So I asked them, how much of this typical property that you just rattled off the way you own it is covered by your perfect will? And the answer is generally none of it. Most property today, you may have updated your plan, but you don't really have a plan. Most property passes outside the will. If you have a joint account or you own a home jointly, it's going to pass to the surviving joint owner, no matter what the will says. If you have a beneficiary on your IRA, it goes to the beneficiary named on that beneficiary form, overrides the will. So many people think they have a plan, but they really don't. That reminds me of the saying by the famous philosopher and boxer Mike Tyson. He said, everybody thinks they have a plan until I punch them in the face. Then they don't have a plan anymore. Well, I don't want that to happen to you, a tax punch in the face. So when should you get this all up to date? 3 words: while you're breathing. You get it? Otherwise, it's too late. Make sure you check your beneficiary forms. You know, in our training sessions that Greg has been going to, that's the first item. It's like 101. The first thing we teach on the first course and the first seminar, and we hit it at every one. He's probably heard me say that over 100 times. So he knows to check beneficiary forms. Make sure they're up to date. They coincide with the new tax law. You have primary and contingent, you know, the secondary beneficiary. Sometimes people forget about that, because that's what drives the plan, not the will or the trust. The IRA is going to pass by the beneficiary form. If you don't have an updated beneficiary form, or you don't have a beneficiary named, it may go to your estate, which means it's going to go through probate, which means intestacy, and leave it to the state to do your plan. You don't want that. It could involve a lot of costs, fees, expenses, and worse, it could go to the wrong beneficiary. So you want to update your beneficiary form anytime there's something that I call a life event. In other words, a change in the factors you relied on for your existing plan. For example, a birth, a death, a marriage, a divorce, a remarriage, you had a new grandchild, change in the tax law. And these forms can be updated anytime. Years and years ago, I'm talking over 20 years ago, there were complex, even more complex tax rules, and there were certain things locked in depending on who you named as a beneficiary. That has gone away. And I remember trying to explain this to someone at one of my seminars, and I kept pounding. I said, you can change the beneficiary form anytime you want. And he said, oh, this is great. I said, what do you mean? He said, I call this my IRA leverage. I said, what are you talking about? He said, well, I just turned 80 a couple of weeks ago. We had a big party. 2 kids didn't show. They're out. So that's why I added somebody forgetting your birthday. Maybe that's a reason to update your beneficiary form. Just saying, make sure these things on everything you own, your IRA, your 401k, life insurance, annuities, anything beneficiary driven will override the will. So the will is not enough. That's the point I'm trying to make here, to secure it. That's the second step. The third and fourth steps, now we're getting into ways to move from forever tax, is my favorite part, to never tax, because I love tax-free, where you keep all of your hard-earned money. And the first way is the Roth IRA. I love Roth IRAs because everything in Roth IRAs grows tax-free. I call it the tax deal of the century. And you should look at it, at least have an evaluation to see how much or what you should do, have an evaluation to see if you should convert your IRA to a Roth IRA from forever tax, tax deferred, to tax-free. But there's a catch. We're back to the secret. You have to pay the tax up front. But if you can get rid of that tax while rates are on sale, rock bottom tax rates, you'll never see the rates this low again probably in your lifetime, even for people that think I'll be in a lower bracket in retirement. Remember, if you do nothing, the account just builds and builds and builds, and you'll still be subject to these required minimum distributions, maybe on a higher balance and at a higher rate. So that's the secret to moving your money from forever tax to never tax. Pay some tax now. There's no income limits, no conversion limits, no age limits, but be careful. Remember before when I said these tax rules are not only complex but rigid and unforgiving? Roth conversions under the tax law, this was changed a few years ago, are permanent. Once you do them, yes, you will owe the tax. That's why you want to do a good tax projection, a good evaluation. And that's not a reason to deter you from the Roth. Just be careful how much you convert. You don't have to convert everything. Maybe the best move for lots of people is to do a series of smaller annual conversions over time. You start taking down that taxable IRA, getting rid of that tax bill, and building up over time in tax-free. Once it's in the Roth, you'll never pay taxes on it again for the rest of your life. It eliminates the uncertainty of what future higher taxes can do to your standard of living in retirement. And guess what? Now you have your plan, not the government plan. There are no required minimum distributions. So you can keep your Roth IRA building, growing, compounding for you. 100%. You keep all those gains instead of the IRA that's growing partly for your partner, Uncle Sam. Roth has no partner. You keep 100%. So there's no RMDs. I mean, you can take money if you want, and it'll be tax-free, no matter how high taxes go. In fact, when taxes go up higher, anything tax-free like a Roth is worth a lot more. Yet, people still have some reservations about these. So let me go through some of these things. People say my money will be tied up. These are really myths. So I want to cover these things because these are comments I get at programs. My money will be tied up. Not at all. Not if you use the Roth IRA the way it's intended. Yes, you have to have 59 and a half and 5 years. But if you use it in retirement, you've passed those thresholds. If you use it for long-term in retirement, everything you take out will be tax and penalty free. All the growth, tax free. Some people say, well, that's good, but if I convert, my taxes will go up in the year of the conversion. My income will go up. That would make my Medicare surcharges, for example, go up by Parts B and D, maybe taxation of Social Security. But that only happens in the year of the conversion. Again, you got to get rid of that short-sighted thinking. So people tell me, well, if I convert and my Medicare premiums go up, that would make me angry. So you know what I tell those people? Well, I'd rather have you be angry, do the conversion. I said, I'd rather have you be angry 1 year than be angry for the rest of your life. Because if you don't take action, again, that account builds and builds and builds, and at 72, you'll be forced to take it out on the government plan. Then you'll be angry every year for the rest of your life. Some people say, well, if I convert, they don't get the secret. They say I'm out money up front. There's a lost opportunity cost. Some accountants, my own colleagues, own CPAs, tell me this when I do training sessions for them. They say, again, too short-sighted, because accountants, we're all hardwired. We always tell clients, never pay taxes before you have to. So we have to get out of that. That's why I'm a recovering accountant. I see the benefit of paying a small amount now to have a windfall later tax-free. Like, again, paying off that debt early. So they say there's a lost opportunity cost because the money you're laying out for taxes up front is gone. It's lost. We could have invested that money. Not true. So I gave you the math. You could share this with your accountant. It's all about comparing tax rates and earnings rates. And if you compare apples to apples, like the comparison I have for you right here, you'll see it comes out the same. If the tax rates are the same before and later, and the earnings rates are the same, everything's the same. There's no opportunity cost. So for this example, I estimated a 30% average tax rate. Really doesn't matter what I estimate as long as I use the same before and after. comparing apples to apples. Same thing with the earnings rate. If you look at it, I didn't even use an earnings rate. I just said the money doubles over your lifetime. That's nice and easy. So let's look at it. Let's say you're deciding, I have $100,000. Should I convert or not? Well, if you don't do a Roth conversion, you keep your 100,000, that's the left side of the screen, and it will double over time. So now you have 200,000. You're not out anything. Then the 30% tax hits on the 200,000, you net 140. With a Roth conversion, you take a hit up front, the 30%, but watch, look what happens. The 30% is on the value now, as opposed to the IRA, the 30% was on the value that it grew to. So you're left with 70,000, but it doubles, is your same 140. So if the rates stay the same, there is no change, there is no opportunity cost. But if rates go up at all, which is pretty likely, let's say, and it's pretty likely rates won't go down, that's almost assured. If rates go up, the Roth Advantage skyrockets. But here's what I love about the Roth. Let's say I'm wrong about everything, that tax rates don't go up, in fact they go down. I doubt it, but let's say I'm wrong. I always like to look at the worst case scenario if we're wrong about a decision. That's good advice in anything, any decision. What's the worst case scenario? If I'm wrong about everything, if you do the Roth conversion, you've locked in a 0% tax rate for the rest of your life. That's not a bad consolation prize. You can't beat a 0% tax rate, and you've locked in today's rates, and you've freed up that money. It grows tax-free for the rest of your life. Not a bad deal. Something you should definitely look into and evaluate as a hedge against the uncertainty of future higher tax increases. So that's the Roth. Insure It is step 4, similar to the Roth, but a little more powerful. Now again, I'm talking about life insurance. I said it before, but I want to say it again. I'm a CPA, a tax advisor. I do not sell life insurance. I don't sell stocks, bonds, funds, insurance, annuities, none of that. But as a tax advisor, I have to tell you the tax exemption for life insurance is among the single biggest benefits in the tax code. And now the Secure Act has made it even more useful. Why? Because Congress, all they did with the Secure Act is incentivize us to find another way. That's all. Incentivize us to do the better planning we should have been doing all along. So now Congress has downgraded IRAs because they killed the stretch for transfer to your beneficiaries, but they've upgraded life insurance. Life insurance, and I'm talking permanent cash value, not term, may now be the new stretch IRA. Who's most at risk for planning after the end of the stretch IRA? Well, those of you with the largest IRAs, because more of that will go to the next in line beneficiaries, and they will have to pay all of that tax bunched in not to 80 years, but into a 10-year period. So a lot of that is going to be lost to taxes. And almost everybody else, where you have your largest asset, may be that IRA or 401k. Greg said that at the beginning of the program. For many people, your IRA or 401k is your largest single asset, and it's all loaded with tax. So these are the people, many of you probably, that are most at risk. I believe life insurance is the big defense now. That's the plan. I'm talking about cash value policies that actually have lifetime benefits. This is the way to create larger inheritances with more control, especially if you need a trust, and less tax. It can replace the benefits of the stretch IRA, and especially some of you may have very large IRAs where you've named a trust. After the end of the stretch IRA, after the Secure Act, many of these trusts no longer work to meet your objectives. You won't get the post-death control, and taxes could be very high. Life insurance is the best, most flexible asset to leave to a trust, much better than an IRA. It's more tax efficient, it's income tax free, and it can also be, life insurance I'm talking about, it can also be estate tax free. IRAs, even Roth IRAs, are always included in the estate, and it's the best asset to leave to a trust. You don't have these complex IRA rules, the tax rules, no RMDs, and remember, life insurance can provide benefits during life. You can have a policy like I have. I have these myself. I have a hybrid life insurance policy, meaning that it has a long-term care rider. So if I need funds to take care of, say, for nursing home during my life, comes right out of my life insurance while I'm alive. So there are lifetime benefits. That's pretty powerful. That's why I switched over to that. And best of all, when the life insurance comes in, it's tax free. The whole shebang, tax free. So here's my own life insurance replacement plan. I wrote Ed Slott's life insurance replacement plan. It doesn't say that in the tax code. I gave you this. So it's very similar to a Roth IRA. Remember I said with the Roth IRA, you take the money out. Yes, you'll pay some tax up front, and then you put it in a Roth where it grows tax-free. Well, here, same thing, pay down the IRA, get rid of that growing, building, looming debt in the IRA at low rock bottom rates. You could do that over a number of years, and then after the tax is paid, use the funds to purchase life insurance. If you think you need a trust for post-death control, you leave the life insurance to the trust, or leave the life insurance directly to your children or grandchildren. And the minute you do that, you get the same benefits as Roth IRAs. You've reduced your future tax rates because as the IRA balance goes down, your RMDs go down, so your future taxes go down. Plus, now the money is growing, the cash value, like in the Roth IRA, tax-free to have available to you during life. Or if you don't need it, hopefully you don't, most people don't, it's a windfall, a tax-free windfall to your beneficiaries. That's why I say it can create larger inheritances, more control, and less tax. But it's not the be-all and end-all. That's why you need to speak with an advisor like Greg. Here are some of the downsides. There are downsides to everything. Everything has pluses and minuses. In both of these scenarios with the Roth IRA, if there's a minus, you have to pay the tax up front. But remember, I said that's the secret to this whole thing, getting rid of the tax bill so you keep more of your money when you need it most and to pass on to beneficiaries. So one caution, you might say, this sounds good, Ed, but I'm not insurable. Not everybody is. But you know what? There are other products like annuities. Again, I don't sell these things, but I have them myself that can provide lifetime income, long-term care benefits, and death benefits without a medical exam. So that's pretty amazing. I have these things myself because I love a guaranteed income for life. In fact, the only thing better than having guaranteed income for life, not for everything, everything's in moderation. That's why you work with an advisor to have the best plan for you. The only thing better than guaranteed income for life is what I have. So now you're thinking, what do you have that's better than that? Well, I combine the strategies. Guaranteed tax-free income for life. How do you get that? In my Roth IRA, I have some of these annuities. So if I ever need money from there, it not only pays guaranteed, but because it's in a Roth, guaranteed tax-free income for life. So there's an alternative to life insurance. So, these are things that are available to take advantage of. The other, if there's downsides or disadvantages, you might call pros and cons, the other side of the coin for life insurance. Yes, it is a long-term commitment. You will have to pay, if you're using the IRA money, you'll have to pay tax up front. But to me, that's a good thing to get rid of that bad debt, like paying off a mortgage. And hopefully it's for money you won't need during your lifetime, so you have to evaluate what's best for you. Always consult your advisors on this. So that's the power of life insurance. Actually, that's what I called the chapter in my life insurance chapter in this book, The Power of Life Insurance, because it's so powerful. What a way to simulate the stretch IRA and actually put your beneficiaries in a better position than if they inherited a taxable IRA, even under the old rules. This is way better, I think, my opinion. Again, look and go over it with your own tax, insurance, and legal advisors. That's the insurance step. Now we're coming down to the home stretch. Avoid the death tax trap. Now, I did a study. 3 out of 3 people will die. Obviously, this is not like 4 out of 5 dentists. No, everyone will die. So the idea is to get this taken care of now, and you have the opportunity. The bottom line is the Secure Act eliminated the stretch IRA. Your plans will probably change. Check your beneficiary forms. They may not work anymore, especially those of you who have large IRAs. You may have named a trust. Review every beneficiary form. That's your estate plan, not that perfect will or trust. I'm worried tax rates will increase at some point. Look at our looming debts and deficits. At this point, it doesn't matter what side of the aisle you're on. Any politician that says now I can cut your taxes is really saying I'm bad at math. Please help me. Well, I believe tax rates will have to increase soon because the skyrocketing debt and deficits are out of control. At some point, the bill's going to come due, and that's not the time you want to be holding a taxable account like an IRA. So I'm worried tax rates will increase soon, but I gave you 2 ways to move from forever tax to never tax: Roth IRAs and life insurance. So that's our 5 steps. But the point is to get this done now. Now is the time to create your plan. I did these seminars for years. 30 years ago, I started to, I think even longer than that. And whenever I did these in person, which I hope to do soon at some point, people would say, oh, that's compelling. You made a good case. Yeah, I got to get on that. But they would always have an excuse. Now is not the time for excuses. I think we still have these low rates for 2021. Whatever Congress does with the new taxes, I think will generally be effective in 22 because we're too far into the year for them to make it retroactive. But you can never trust them. But we know what the rates are now. These low rates, remember, that's the secret, to get the taxes out at the lowest rates. So it's no time for excuses. Get your plan, not the government plan. Imagine you were taking a car trip and the check engine light went on. Well, wouldn't you do something about it? I'm telling you, the check engine light is flashing bright red on your retirement account. Help me, save me, save me. I gave you the 5-step plan to disarm that ticking tax time bomb. The Green Bay Packers coach, Vince Lombardi, had this great saying: the Green Bay Packers never lost a football game. They just ran out of time. I don't want you running out of time. Remember, just like football, it's the score at the end of the game. It's how you finish. It's not how much you have, but how much you keep after taxes. You could say taxes are kind of like the Indy 500 coming up. You have to finish the race. A lot of cars crash. They never get to the end of the race. So that's kind of like this is a bit of a stretch, but I wanted to tie in the Indy 500, right? Some cars never make it to the end. They have crashes. They get hit. That's kind of like your IRA getting hit with taxes along the way. They're no good. They won't make it to the finish line. So that's my analogy for the Indy 500. But you see what I mean. In football, they have a saying, the score at halftime is irrelevant. Give me the score at the end of the game, and then I'll tell you who won. It's what you keep after taxes. So the key is to have a plan now, which you have available to you. You just have to get it done, but don't wait. Otherwise, it could be too late. General Douglas MacArthur said, every military failure can be summarized into 2 words: too late. Don't let it be too late for you. Learn from history. Remember what I said? Take action. I believe taxes will increase, leaving you with less when you need it the most. Remember the secret. Move from forever tax to never tax. Remember my always rules. Always pay taxes at the lowest rates. Get rid of that so you have more, keep more, and make it last later. Because tax-free is always better. Throughout time, everybody has complained about taxes. Everybody complains about taxes. Well, you can keep complaining or you can do something about it. It always comes down to this. The more you plan, the more you keep. I want you to have more, keep more, and make it last. And you have the opportunity of a lifetime right now with one of the best trained advisors in the entire country. That's Greg Storen. I know because I've seen him in our training classes for almost 20 years. That's the opportunity you have. So you have access to great planning, and Greg, as I said in the up front, he has access to me and my team of experts as his back office. So you have the opportunity. Rates are low. Now's the time you want to get it done before you get the government plan. Remember, I want you to have your plan, not the government plan. Move your money from accounts that are forever taxed to never tax. Why? Because I think after this you'll have to agree with me that tax-free is always better. You keep 100% of your hard-earned money. Well, that's it. Now I'm going to bring Greg back in. Now, I told Greg this would be his secret cue to come back in when I say time to bring Greg back in. You like that, Greg? And there he is. So that's the story, Greg. You take it away from here.
Brilliant. Thank you, Ed. I appreciate it. So exactly what I expected, full of information, and I really appreciate it, Ed. So it's a highlight to have you here, and we've had roughly 200 people on this call.
Wow.
That's
And you know
phenomenal
what?
number.
At some point, we're going to do this in person, and then you and I are going to go into town, your town, and go to my favorite restaurant in the country, St. Elmo's. You know, I mean, I've been so on withdrawal from that I order the stuff online, the cocktail sauce, I mean.
You
and
still
the
get their
steak
sauce, don't you? Yep.
That gift basket, you can get it online. I get that gift basket. I have my shrimp with the St. Elmo sauce, and it makes me feel like I'm there. But one day we're going to go back there, and I hope that day is coming soon. Now I'll let you close up.
It makes you sweat.
Yeah, I love it.
Well, Ed, we appreciate it. We appreciate you. And, you know, a lot of what you talked about, a lot of my clients have heard about it, and they hear this. And to your points, you know, I talk about making a deal with the devil in terms of Roth conversions, and folks don't want to pay the tax, but Ed's right. Taxes are going nowhere but up, and clients know that. A couple key points that I think Ed brought up that I think everybody needs to think about, and that's Roth conversions. You know, young people need to do Roth contributions. Retirees always think about Roth conversions. And as Ed said, the government plan or your plan, don't just sit back and let life happen. Meet with an advisor, meet with your tax advisor, talk about this stuff. If you're not hearing it, we can help you. And I know you're hearing it from us. And we can, you know, this Roth conversion doesn't have to happen in 1 year. Like Ed said, we can do this in pieces, pay the tax over time. And remember, one of the points, when you're 72, if you don't have a traditional IRA, you're not taking a required minimum distribution. So you're in control, not the government. So that's key, I think. The other thing is with some of these proposed estate laws that are changing, life insurance may be even more relevant going forward. So life insurance is going to be more key. So Ed, some great points. So thank you. A couple of housekeeping real quick. We're going to have one survey question when the call is over. Simple question. Do you have any questions for us? If you do, just mark yes. I'm going to just reach out to you personally and make sure your questions get answered. The other quality thing is that you're going to get a copy of Ed's book, The New Retirement Savings Time Bomb. So this is a phenomenal book. It just came out about a month ago. So everybody on the call is going to get Ed's book. So just go ahead. This book can be picked up at the Zionsville office, the Brownsburg office, or please email us at investment@storenfinancial.com, investment@storenfinancial.com, and we can make arrangements to get you the book. And again, at investment@storenfinancial.com, shoot me an email with your questions, or just go ahead and answer the question yes, and I'll reach out to you. So that is it. I appreciate everybody's time today. Ed, thank you again. Thanks to all the participants, and have a great night. And folks, we really appreciate it. Take care.